Good morning, everybody, and welcome to this Tuesday, March 5th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next 30 minutes or so as we take a look at some charts and figure out what happened in the market yesterday and where we might be going today and through the rest of maybe the month of March. Interesting day. We'll be taking a look at the 10-year Treasury yield, but it is breaking back down beneath 4.20%. And lower yields a lot of times make utilities look a little bit better because utilities appeal to a lot of income investors. And so as the 10-year Treasury yield moves lower, the dividend yields on utilities can start to look quite delicious. And as a result, we could see money rotating there. It also happens to be one of the best months of the year for utilities. So I would say you want to keep an eye on utilities. I've been talking about this as a group that is much more conservative. So many of you who are more risk averse, I think utilities could certainly play a role in your portfolios here in the month of March. Again, historically, it's a great month. And if yields continue to drop on the 10-year Treasury, that's something that normally sends money into utilities to begin with. Well, why don't we go ahead and get started and take a look at the action from Monday, because you'll see that utilities actually were the best performing sector. So let me get the settings set up here for you. As my bad. Wasn't quite ready for that, but I'll get you going here. All right, there we go. So let's take a look. We got the Dow Jones Industrial Average yesterday down 97 points. That was about 0.25%. S&P 500 dropped about 1/2 of that, 0.12%. S&P 500 was down 6, back to 5131, still well above 5100. Markets continue to do well so far this year, but just going to keep reminding everyone, maybe we go through March unscathed, but this is the month you do have to be a little bit cautious. You have to lower that bar of expectations because it's the month where a lot of times we see money rotating away from growth and into more value-oriented areas like utilities. So don't let it catch you by surprise. If we do pull back, it's very, very normal. And in the month of March, we're actually getting ready to head into a period where we tend to see that pullback. And latter part of this week and into the early part of next week, I would say is where we normally see the most weakness in March. That's historically, doesn't mean it's going to happen this year, but we want to at least be aware of that and be prepared for it. So again, lower that bar of expectations. Nasdaq 100 down 0.4% yesterday. That was 76 points. Still trading up above 18,200 though. It's been a beautiful move up off that October low across the board, and we are still trending above the 20-day moving averages, which are trending above the 50-day moving averages. AD lines continue to look strong. Don't see a whole lot wrong with this market other than it could just use a little bit of profit taking to unwind some of the overbought conditions. Mid caps, you can see have taken a move to the upside. I think the month of February has really changed things on the chart of both the small caps and the mid caps. You can see we were struggling in January, couldn't get a new high. If you look back to the Nasdaq 100, we were breaking out the new highs in January. S&P 500 breaking out the new highs in January. Dow, same thing. Mid caps were not. Small caps were not. They were lagging in January. Now they're coming back and rallying. And this is a little bit of how a secular bull market just works. We see leadership in certain areas of the market, and you've got folks saying, well, yeah, but they can't, continue to go higher. Well, they won't. At some point, they'll pull back. But the question is, does the money leave the market, or does it simply just rotate into another area? And the fact that so many different areas of the market now are looking much more bullish, that's going to increase the odds that this money is not really going to leave the market. We're not going to see a big sell-off, in my opinion. I think it's going to be certain areas. I could see the Nasdaq 100 pulling back for a period of time, but it looks like that money is finding a new home in U.S. equities. And that's a good sign, and it's consistent with what we expect during secular bull markets. Anyway, mid caps breaking out here in February, looking really strong. AD line is just soaring. Same thing for small caps. breakout not quite as clear, but we have definitely traded up into areas we have not seen in a long, long time. AD line on the small cap index also looking pretty strong there. Transports continuing to consolidate. This is the one group that really hasn't broken out from that December high. And it's a really important area of the market, because if you're expecting that the economy later this year is going to be pretty good, and that inflation will be tame and rates will stay low, we should be seeing transports breaking out. That we haven't seen yet. AD line, though, remains pretty strong, strengthened in January and also a little bit in February. But we need that breakout. We need that price volume confirmation. We haven't gotten that yet on the transports. It's one of the few groups still waiting on that breakout. Leading to the upside from a sector perspective, utilities. So I was talking about at the top of the show. And if you look back, I mean, I look at utilities here on the chart and I say, well, they're not performing very well. They look pretty bad technically, beaten down. Are they just going to, start moving up without any real technical support, any kind of a base or anything? I mean, we've been downtrending. Well, what I can tell you is that in the last 5 years, it's looked almost identical to this with utilities going into March. So the only month that kept going lower, the only March that kept going lower in the last 5 years has been the pandemic of 2020. And during March of 2020, if you recall, defensive stocks got hit harder than aggressive stocks and took longer to bounce back. So if we just kind of consider 2020 and the pandemic as an outlier, utilities are right where they want to be, apparently. Downtrending at the end of February, and then all of a sudden, March comes in and utilities start to lead again. So yesterday, up 1.7% on utilities, leading all the major indices, all the sectors higher. Another defensive area, real estate, in the second spot, and then a neutral sector, materials, in the third spot. So yesterday was one of those days where we were seeing some rotation away from those aggressive areas and into more defensive areas. And this is quite typical during the month of March. It's also fairly typical during the months of June, September, and December. And the common theme in all 4 of these months is that they're the third calendar month of a calendar quarter. So we get the pre-earnings run, we get the during the earnings run in the aggressive areas. And then once we get through most of earnings season and we start, kind of slowing down on the earnings front, that's when we normally see rotation, profit taking in some of those growth areas, and then rotation into some of the defensive areas. It's not a bad thing. And it usually coincides with the market either going sideways or pulling back. Now, what would be a bad thing, or maybe a thing that, would at least get our attention, make our, maybe our antennas start to rise a little bit, would be if the stock market kept going higher in March and the leadership was clearly in the defensive area. That would at least put us on notice that we've got defensive groups leading the market to the upside. When the market's going down, defensive groups almost always lead. That's profit taking. When you have market going down in an uptrend, first thing that's going to be sold probably are the areas that have nice profits. So you're going to see technology and consumer discretionary, communication services, maybe financials and industrials to some degree. They'll take a little bit of a pause, and then we'll see some of these other sectors lead. So during a pullback, don't view leadership from defensive areas as overly bearish. That's just kind of normal during any pullback. But if the market keeps going higher in March and especially into April, and we're seeing defensive stocks lead, that could be setting us up for a rough summer. But I'm not going to get too far ahead of ourselves. We keep trying to talk about this pullback and never seems to occur. So let's just keep following that price volume, which is our number one indicator. And right now, market just keeps going higher and higher. Can't really argue it. I mean, unless you've got your computer sitting upside down, it's pretty easy to see stock prices keep going higher, and they're going higher in a lot of areas. Moving on to the industry groups. It's really interesting because the 3 worst industry groups yesterday, autos, computer hardware, and internet, are home to 3 of the really big Mag 7 stocks that everybody talks about that's, been leading the market, and therefore the market, this isn't a true bull market because it's been led by the larger companies. Well, larger companies are the better companies. They're the ones that employ the most people. And so I don't know, I kind of feel like it's good when these stocks are leading over a period of time. I mean, I want them to lead because they're going to have the biggest impact on our economy if they don't. But anyway, that's my view of looking at it. But if you look at these three, automobiles, what do you think when you think automobiles? Tesla. Tesla is really struggling. It was down again in pre-market. Actually, let me see. Yesterday had a rough day, rolled over, was down $14 to 188. It's down another $5 this morning to 183. So we are quickly on Tesla moving back close to those, getting closer and closer to that early February low. How about computer hardware? Anybody think of a name maybe that goes along with computer hardware group? Maybe Apple might be a pretty decent sized company to consider. Apple broke down. Apple's broken down below 180 support, and looks to me like it probably is heading for 160 or so. But if I pull up Apple this morning, well, yesterday it lost $4.56, 175.10. It opened yesterday, though, by the way, at 176.15. So of the 456 that it was down, about 350 of it was at the open. I mean, I just wrote an article over the weekend about how I believe Apple's being manipulated. I think it's continuing, even on the breakdown. Big gap downs. You gap down $3.50, and then you only sell off $1 during the day when you can actually have distribution, when institutions can unload shares. They're not going to unload shares on a gap down. It's just not going to be enough volume at the opening bell. And market makers their participation in after hours and pre-market is voluntary. So it's not liquid. It's not a period where institutions can get out. They have to get out during the day. And we're just not seeing the kind of selling in Apple that indicates to me that this is a long-term big problem with Apple. But short-term, yeah, it's a problem. It continues to go lower. Today, it's looking to gap down almost $4 again. So yesterday we gapped down 350, then we go down another $1 during the day. Now we're set to drop another $4. I mean, it counts. If you got Apple in your portfolio, if you own it, you're losing money. I'm not trying to say, hey, call up the market maker or call up your broker and say, well, I don't really want to sell. I want to sell at the pre-manipulated price. That's not going to work. But I do take notice when a lot of these moves to the downside are gap downs, whether it's our major indices, whether it's individual stocks. But Apple has been showing relative weakness for quite a while. So there's a little combination. There's no doubt it's obviously not keeping up with some of the other Mag 7 stocks. And as a result, it's probably going to continue to suffer here in the near term. But anyway, Apple, big part of that computer hardware group. So there's two reasons right there why those two are down. How about internet stocks? Now, right now, first internet stock I always think of is Meta, because that's the outperformer. That's the one that's leading. That's the one I like. One I don't like is Alphabet, Google. So let's pull that one up. Or I'm pulling it up on my other computer. But Apple yesterday down $4 to 133. That was the lowest level it's traded at in 2024. So it's now down year to date, and it's down another $1.30 this morning, another 1%. So these are three key stocks that are going down that I'm pretty sure that if you ask just about anyone, including me, if you said, hey, if Apple and Tesla and Google are all setting new lows in 2024 or close to new lows in 2024, might the S&P 500 still be setting all-time highs? I mean, when you think about the fact that these three companies are very heavily weighted in the S&P 500 and in the Nasdaq 100, you'd think they'd have more of a downward effect on our major indices. But instead, market's been holding up. And again, it's that rotation. Money's coming out of these big stocks, but they're finding a home in other areas that are looking really good. I'll talk about that a little bit more as we go throughout the show. But I just thought it was interesting that the three groups that were lagging the most are home to three companies that we're used to seeing go higher during bull market runs, and they're not. So we'll watch these three, but I think it's encouraging that you're losing leadership from three very, very significant companies in the market, and the market's still going higher. Chalk it up to rotation. 10-year Treasury yield. Let me get an update here. Make sure I got the latest. We are right now at 4.16%. So remember, on Friday last week, we closed below 420. Remember, 420 was the level that I wanted to watch as support. So on the way down, we rallied back. That was our reaction high, 420. We went back down almost all the way to the low. So we were kind of sideways consolidating, trying to figure out which way we were going to go. Well, with the January CPI report coming in hotter than expected, that sent the yield through that 420 level. And if you believe that inflation is a problem or continuing problem, or maybe a problem that's going to worsen at some point, that 10-year Treasury yield breaking out would help support that case. Problem is, it's not holding. Now we're seeing the 10-year Treasury yield roll back over. And that tells me that the bond market really isn't considering inflation to be a problem, which is what we've been talking about for quite a while. It's also why we've been seeing all this money rotating into growth, and why growth stocks have been continue to lead to the upside. Higher inflation eats into future earnings growth. And so companies that are reliant, their market caps are reliant on that future growth, get hit the hardest when inflation becomes a problem for two reasons. Number one, inflation itself is bad because it's just chewing into those future earnings. But then the higher inflation also triggers the Fed to act. And so we start to see higher interest rates, and higher interest rates bring those future earnings back down, and they're not as valuable. I mean, we use interest rates to discount those future earnings and future cash flows. And so when rates are on the rise, if everything else is equal, valuations will come down. Just interest rates going up alone will create that move to the downside in valuations. But now we're seeing things roll back over in the 10-year Treasury yield. It's going to be a really interesting month because I think it's next Tuesday. I think it's a week from today, the 12th, that we have the February CPI coming out. And that could either light an absolute fire under the market if we have a below expectation report, or maybe this little move below 420 is just a little head fake, and we have another hotter than expected CPI report, and then that could be the trigger for a much bigger sell-off. So like I said, March is going to be a really interesting month. And I'd like to tell you, I know what all these reports are going to be when they come out, and therefore where the market will go. I don't know. All I know is that my signals continue to point bullishly. So short term, like I said, I lower the bar of expectations in the month of March. I wouldn't be surprised if we get a pullback at some point. I've been saying that really since mid-February. And the market just keeps not exactly flying, but it keeps making new highs. But when the market falls, it tends to fall quicker than when it rises. So just be on the alert. I think it's important to at least be on the alert for a possible pullback to some degree this month, with areas like utilities, real estate, staples, maybe leading to the upside on a relative basis. All right, let's keep moving. S&P 500. This is what I'm talking about. So mid-February is when we started talking about this. That was about maybe 100 points ago on the S&P 500. So maybe 2% we've gone up since then. I mean, honestly, when the market goes down, 2% could be a one-day thing. We could be right back down, to 50-50 or below in a day if the market just, has a bad day. And then if you have a day like that, next day you could open down 2%. I mean, all of a sudden you're down 4%, and there's a quick little pullback. That could happen between now and next Tuesday, between now and the CPI report. Who knows? I'm not saying it's going to. I'm just saying it's possible. Really hard to predict the stock market day to day. I don't know anyone that's really that good at that. I mean, sometimes you can look and see candlesticks. maybe you've been consolidating for a while and you finally make a big breakout, then you might expect that, you get some follow through to the upside. Or you got negative divergence and you got a big bearish engulfing candle, something like that. That would signal the likelihood of a move down in the short term. But outside of that, I mean, trying to predict the market day to day is really hard. I think I'm pretty good long term. I think I'm, decent intermediate term. Short term, I mean, the market does what it wants to do. I like to look at it in terms of I have an idea maybe of what I expect highs and lows to be as we go throughout the year. And just when we start to sell off or pull back, I kind of look at that bottom level just to make sure that holds. I look at my different intermarket relationships I like to follow, make sure that looks good. I check out sentiment, see what's going on with sentiment. And the market still remains fearful. There's a lot of folks saying that sentiment's overly bullish. I don't see it, but I don't follow people, or I don't follow the sentiment readings that talk about how we feel. I feel bullish. I think the market's going to go higher. I mean, those are words. People may have agendas. I don't trust any of that. What I trust is the money going in the market. And so my favorite sentiment indicator involves the equity only put call ratio, because that's money that's going in the market that's buying puts or calls. Make no mistake, you can tell when the market's overly complacent and when it's overly fearful. And that, I mean, right now, short term, it's kind of a neutral reading, not really telling us the top's in place, not really telling us anything. But the long-term moving average of that equity only put call ratio is telling us the stock market is going higher, and it's probably going a lot higher. But the long-term moving average doesn't dictate what happens over the next 2 weeks. It's talking about next year, the year after that. We're probably looking at we're in the midst of what I think is a pretty significant advance to the upside, but we're going to have pullbacks along the way. And if you can time them, I mean, that's great. And sometimes we can, but it's certainly not an exact science. Nasdaq 100 fell a little bit more yesterday. I mean, the day kind of felt a little strange. We were really going up slowly, not really doing much of anything. And then finally in the last hour, I mean, if you look at a intraday chart, here's where we started. We were kind of low and we bounced. We came back down, really doing almost nothing. And then it looked like we were going to make that breakout in the 2 o'clock hour around 2:30. Went back up, got to the high of the day, almost to where we were on Monday. And then in the last 45 minutes, all of a sudden, it was the biggest selling episode that we'd seen in at least the last couple of days, probably going back to Friday of last week. Or actually, that's Thursday of last week. So I don't know. With futures down, it looks like we're starting to roll over. So I moved then to the hourly chart. Hourly chart, we're moving up. PPO looks pretty good. Looks like maybe the NDX from 18,226 down to 18,186. That's 40 points would get us the 20-hour moving average. And then the other thing that I would probably look at are these highs that we had. So almost to 18,050 there, topped at 18,050 there, almost to 18,050 there, and then finally we break through. So to the downside, I would say probably that first area of support on the Nasdaq 100 be 18,050, which is 175 points on the Nasdaq, lower than where we finished yesterday. So, I mean, that's definitely a possibility short term. Small caps, IWM, nice little cup handle. We're in the breakout. It seems like if the overall market pulls back, this would be, at least from a technical standpoint, I think this is probably the best looking area, or one of the best looking areas, along with mid caps, because we're just making a breakout. No, we're not overbought. We've been going sideways, consolidating for a while. PPO off the center line, starting to strengthen. So it seems like bullish momentum is accelerating on this index. So I think anything down to the 20-day moving average is a buy on the IWM. And if I pull up the MDY, which is the mid caps, I mean, you can kind of see even a more bullish kind of a look to the chart. Look at all the hollow candles. Selling just is not sticking right now in the mid caps. And small caps were pretty much the same way. If I pull up the IWM, you see a lot of hollow candles in here. Yesterday was probably the worst day from an AD line perspective since back at the end of January. I mean, it's probably been 5 weeks since we had a day like that, but volume was the lightest we've seen the whole month. So it's a light volume pullback. It wasn't like all out distribution or anything. That's why I believe any kind of a pullback, small caps, mid caps, is an opportunity. And then finally, transports. Transports just sideways again, not really showing us anything just yet. Maybe equal highs, rising lows. I mean, is this going to develop into an ascending triangle with, where we get a breakout maybe later in March? I don't know. That's one possibility. Could just be sideways consolidation. Maybe we go back to 15.2 again. Been down there a few times now. I don't know what I want to keep going down there. I think the more and more times you go down, I think the odds start to increase. You're going to break down. So I'd like to see it maybe hold 15.4 on any selling. And then you got 16.2 to the upside. Let's see which one of those levels breaks. Moving on to the chart of the day. Couple things. Number one, I've talked a little bit about history earlier. I mean, utilities love the month of March. Well, I have a much more general, broad, what I call Bowley trend. It's really just market history of the S&P 500 and how it trades. And I think you'd learn some very interesting historical facts if you download this report. This is a free report. I can't even tell you how many thousands of hours of historical research over the years. Thousands, easily thousands. And I'm basically summarizing it and handing it to you on a silver platter. I want people to learn more about the market. There are some basics I think everyone should know. This is one of them. I mean, if you're a trader, if you're an investor, there are times of the calendar month that are much better to buy than other times, just historically. And I think the numbers are staggering. But check it out. I mean, don't take my word for it. You got an opportunity there. Also, sign up for our free EarningsBeats Digest newsletter. It's a 3 times a week newsletter, Monday, Wednesday, Friday, trying to offer up some educational information I think that will help. Occasionally, there's some trade opportunities if you choose to take them. Of course, they're your responsibility. But I'd pull up individual stocks from time to time, tell you what I like about them, maybe what I don't like, key support, what might happen if this breaks, the fact that maybe it's a part of a really strong industry group. A lot of things going on. But anyway, make sure you sign up for that. Name and email address, all it takes, no credit card required. Let's see, what else do we have? Let's move on. So I thought what we would do here is just take a look at a stock. And actually, I thought it was showing up here, but it's not. But let's take a look at HIMS. This is HIMS and Hers Health. And we had the big move up to about $12 on earnings, kept going higher. And I always talk about when this happens, it's one of the biggest takeaways for me in earnings season, because I love to trade gaps. But when you get a gap up and you keep going higher on the heaviest volume of the year, that's telling you there's like an insatiable demand for the stock. And so if afterwards you see the volume drop off and you come back down close to the top of gap support, that's a great spot to get into a stock right around that 1240 area. In this case, now it got down to about 1260, and the day of earnings got up to almost $14. So it came back almost 10% in 2 days, got close to that. And then look what happens. This pullback is where I'm thinking about trying to find an entry point, or maybe to start entering with maybe a final entry point at that gap support to kind of build a position. Because from here, really healthy stocks that are turning the corner or have begun to trend higher, many times will bounce right off of this support area. And you can see it here with him. So this is kind of like a poster child of something that I would look for from companies that come out with new information. This is new fundamental information. A lot of people get it in their head that, oh, this was a $10 stock. I'm not going to pay $13 for it. I'm going to wait until it goes back to 10. Next thing you know, it's 20. And then you're like, well, at least let me get it back to 15. Then it's 25. When you get new fundamental information like this, it can be a game changer for sure. Valuations change when you come out with a big earnings report that no one was expecting, and then let's say you raise guidance, the value of your company is so much higher after that because the projection of your earnings growth is going higher, and we're in a very low interest rate environment. There needs to be an adjustment to the valuation of that company. That's what a lot of folks just don't get. And they're afraid to jump into a stock because it's already gone up so much. Anyway, just thought I'd point that out. One last thing, it is 9:30. I wanted to just point out that if we look year to date, I pulled up all the industry groups relative to the S&P 500 and then set it to year to date so that you can see, I talked earlier, Apple's not leading, computer hardware is not doing well. Internet is struggling a little bit because of Alphabet or Google. Auto is horrible because of Tesla. Well, there are still plenty of other areas of the market that are carrying things to the upside. One of those areas is just no doubt semiconductors. Year to date, semiconductors the leader. The last 3 months, semiconductors the leader. Last 6 months, semiconductors the leader. How about over the last year? Semiconductors the leader. I mean, it doesn't matter where. Did I do the 1 year? Yeah, there it is. It doesn't matter what timeline. Semiconductors are just on fire. They are repricing because of the incredible earnings reports that came out in this group over the last year. Every quarter, the numbers are just getting better and the future looks brighter. And that's what's driving these valuations higher. Now, the next thing I did is I went over to the scan engine and I just pulled up a very simple scan to find the semiconductors that I wanted to put into a chart list. So what I did is I pulled up, okay, it's got to be a stock. 50-day moving average volume, daily volume needs to be 300,000 shares. And then the group of semiconductors, and that's all I did. And the way you do this, if you just pull up the, I think when you pull up any scan, a new scan, the default is a 20-day volume over 40,000. So I just changed it to 50-day over 300,000. And then I pulled up semiconductors. You can do that down here under sectors and industry groups. So all I did is I went down and I grabbed semiconductors right there and I hit add. Now I'm going to have one here twice, but that's how I did it. Very simple. I ran the scan and I put it into a chart list. And here's the chart list broken down by summary form. Year to date, look, NVIDIA's fourth. Everybody, I'm sure, thinking NVIDIA or maybe AMD. NVIDIA's fourth, AMD is eighth. There are 6 other stocks in the top 8 that are doing as well, if not better, than NVIDIA and Advanced Micro. I mean, maybe you're not aware of that. And some of these companies are smaller, and they may just be getting started. For all we know, they could be the new NVIDIA coming up. Always worthwhile to take a look at what's going on. I love the reaction in ACM research. I'll pull this chart up and then we'll wrap up. Look at the volume here, over 12 million shares. If you look back at the last year, we've only seen one day over 6 million shares. We've only seen maybe 2 or 3 days over 3 million shares. And we just had 12 million shares. And look at this Maribozu candle. If you're not familiar with the Maribozu candle, it's a candle where you open on the low and you close on the high. And on that kind of volume, what it's telling me is that all day long was just buy. That usually doesn't end with just a move back down into this range. It usually starts a major move to the upside. So this is a stock that if semiconductors get hit and we see the stock fall down another buck or two, maybe start thinking about accumulating it. It's a smaller semiconductor stock and it's an aggressive play. It's very risky. Want to throw all that out there. So if you're somebody sitting back, need to protect capital and you're looking only for income, stay away from ACMR. But if you're somebody that, likes a trip occasionally out to Vegas, I don't really treat trading as gambling because I do think you have advantages where you can take advantage of the house. Can't do that in Vegas. I do think that good traders do have an upper edge in trading and can make money and can make a living trading. I do absolutely believe that. And there are a lot that do it. But it takes patience, discipline, it takes a lot of different things. But this is a stock that I believe could be one that makes a much, much bigger move. Look after the earnings. The next 2 days, it kept going higher. Look at these 2 days volume. Almost 4 million shares. I mean, it's been a huge move on massive volume. I think the stock's being accumulated. And if it pulls back, I think it's just some profit taking short term. Probably will squeeze a lot of people out that chased to the upside that were buying in the 30s. The stock gets back down under 26, and there are going to be a lot of people panicking. But the problem is, if it gets down, or maybe not the problem, but the good thing, if you're looking for a long position, if it goes below 26, it's getting close, very close to an important gap support and the rising 20-day moving average. The closer it gets to 25, 26, the better the reward to risk gets on this stock. So anyway, wanted to point that out. So it's not just NVIDIA. It's not just advanced micro. It's not just semiconductors. A lot of other areas of the market that are doing well. But clearly, this is a group that you want to pay attention to. You want to find the leaders. I mean, I always talk about you can crush the S&P 500 if you stick with leaders in leading industry groups. NVIDIA has been a leader in this industry group for a long time. AMD, same thing. Applied Materials is one that's just been absolutely on fire the last few months. Gap down this morning, already coming back up from the open a little bit. But the market has opened. Let's just take I'll run through the charts real quick. Let's take a look at the spider. Down 0.5%. The Qs down 1%. So we're down 1% there, most of it on a gap down. The diamond down 0.48, and the IWM down 0.44. And you can see this one has actually already got a little bit of a hollow candle. So if you look intraday, the gap's down, and then it's rallying since then. Now down about 0.4%. See what the MDY is doing. So this is mid caps, gap down, rallying. So we're still seeing on a relative basis those areas do well. And I think that bodes well for the overall market. It's great. We want wide participation, and usually that's exactly what secular bull markets bloom into. It's the rotation into other areas that drives prices higher and drives the bears nuts, because they're waiting and waiting and waiting for some of these big stocks to get hit. The big stocks get hit and the market still doesn't go down. Why? Because of rotation. Anyway. All right, that is it for me. I appreciate everybody tuning in. Be sure to go over to EarningsBeats, sign up for a 30-day free trial, try our entire service, or at least get that free report on the S&P 500 history. Make sure you click on that link on our website to check that out, or just sign up for the EB Digest. Best way to get to know us if you're new to the show. Also, please hit the like button. Click the like button, and also subscribe to our channel. Those are ways that you can help us non-financially to just grow our community at EarningsBeats. So we appreciate all of you. Have a great day, and I'll be back tomorrow morning for your next Trading Places Live. Happy trading.